Thinking about using your whole life policy for cash value access? Here's something most people overlook. How your life insurance company handles policy loans can directly impact the dividends your policy earns over time. Some carriers use a direct recognition approach, while others use non-direct recognition, and you don't get to choose which one when it's time to take a loan. That decision is baked into the policy from the start and plays a major role in how your cash value grows. Understanding this difference is key when choosing a whole life policy focused on long-term accumulation. So let's break this down in simpler terms. When you take a loan from your whole life policy, you're actually borrowing from the insurance company, not from yourself. Your policy's cash value acts as collateral, and it still earns dividends, but how those dividends are calculated depends on the company's approach. Let's start with non-direct recognition. With this approach, both loaned and non-loaned values receive the same dividend rate. That means all policy values, whether you've taken a loan or not, can be influenced by the overall loan activity within the policyholder group. So even if you haven't borrowed, your dividend payout may still reflect the broader lending trends within the company. Now let's talk about direct recognition, the approach Penn Mutual uses. With this method, only the loaned portion of your policy has its dividend adjusted. The rest of your policy continues to earn the standard dividend rate. Depending on where loan interest rates and dividend rates stand, this adjustment can result in the loaned portion receiving a dividend rate that's either higher or lower than the non-loaned portion. It's a more tailored approach, keeping your non-loaned values unaffected by loan activity. So if you don't take a loan, no impact on your payout. If you do take a loan, only that portion of the cash value sees an adjustment. That means you're not penalized for someone else's borrowing, and you have more control over your policy performance. Penn Mutual takes it a step further with added stability. Starting in policy year 11, they offer a preferred loan provision, where the loan interest rate matches the dividend rate on the loaned portion of your policy. No matter how rates move, there's predictability. The dividend rate on non-loaned values remains unaffected, and for preferred loans, the loaned value dividend rate always equals the loan rate. It's a long-term feature designed to provide consistency and clarity in how your policy performs. Let's say Sarah has a whole life policy with $250,000 in cash value. She borrows $50,000 to help her daughter launch a business. Because Penn Mutual uses direct recognition, the $200,000 non-loaned portion of Sarah's policy continues to earn the current dividend rate, while only the $50,000 loaned portion is adjusted. And since loaned values still earn dividends, Sarah's money keeps working for her even while she's using it. Here's the bottom line. If you're considering whole life insurance, it's not just about the product. It's about the philosophy behind it. Penn Mutual's direct recognition model puts you in control and rewards you for how you manage your policy. If you have any questions about how loans or dividends impact your plan, talk to your financial professional and make sure your policy is working as hard as you are.
If you found this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss any of our future content.